I am Moumita. In this episode, I will talk about the important economic and financial indicators from last week. We have 7 indicators to discuss today. Let us begin. In number 7, we talk about the China PMI. Both the manufacturing and the services PMI increased slightly in the month of February. Both the numbers came in above expectation. In fact, the consensus expectation was that the numbers would fall in February. Both the manufacturing and the services PMI are above 50, which means that the economy is expanding. There has been an improvement noted in new orders, especially new export orders. However, there has been also a rise in the output and the input prices, which is not good news. Within services, there has been improvement in the construction services. The infrastructure sector is getting a boost as the government has announced an issuance of government special bonds to be spent on infrastructure. The quantum of these bonds is around 1.5 trillion Chinese renminbi. The services and the manufacturing PMI indices show that business activity is improving, but it is at a very slow pace. However, employment situation remains weak. One concern is the China zero COVID policy and the virus containment activities, which has kept the consumption restrained as of now. Moving to number 6, Eurozone retail sales. The retail sales number for the month of January was lower than the consensus expectation. Sales of food was flat from last month. Automotive fuel sales fell from the previous month. The online sales were also down. In the month of January, there were restrictions due to the rising cases of COVID. The mobility had worsened. These are likely factors which have brought down the European retail sales for the month of January. In number 5, Eurozone producer prices. In January, the producer prices number moved to above 5%. This is a very high number and almost double of what was anticipated. The rise has been mainly due to the rising energy costs. It is to be noted that this is the January number and does not take into account the current crisis in Russia and Ukraine. So these numbers are likely to remain high in the next few months as well. In number 4, Eurozone consumer prices. The inflation data for February was released last week. This is a preliminary estimate of the inflation data. The print was 5.8%. Last month, the number was 5.1%. These are very high numbers. Most of the components within the index is rising. The major contributor continues to be the energy costs. However, apart from that, food prices of goods like clothing, appliance, cars, computers, books, etc., they have also increased in February. Europe is highly dependent on Russia for fuel and gas. Europe's relation with Russia, the nature of sanctions on Russia will determine the future of the fuel and the gas prices. There are significant upside risks to these numbers. The trend of inflation in euro area, both the consumer prices and the producer prices are an area of concern. The numbers are coming above the estimates and there is no sign of the numbers slowing down. The things have even worsened in the past month, which will keep the numbers higher in the coming few months as well. This creates a problem for the European Central Bank. The European Central Bank has been quite vocal about keeping rates low to support growth. It has also said towards the beginning of the war in Ukraine that the tensions in Russia and Ukraine will not have an impact on its monetary policy. There is a meeting to be held next week. It needs to be seen whether there is any change in the stance regarding inflation worries from the European Central Bank. Moving to number 3, US labor market. The labor market data for the month of February was released last week. it was a good set of numbers. The non-farm payrolls was significantly higher than expectation. The non-farm payrolls for the previous months have also been revised up. The unemployment rate came down slightly. There was also an improvement in the labor force participation rate. This means that the individuals are returning to work and looking for good jobs. And this kind of improvement was visible across industries. Employment was back in the services sector, especially the leisure and the hospitality sector. Within manufacturing, the construction and non durable goods sector reported a rise in employment. Moving to India, in number 2, we have India PMI. The services PMI picked up slightly in February. After a slow January, the numbers were expected to move this month. However, high inflation and input shortages are still keeping the numbers constrained. Manufacturing PMI also improved in February. There was a pickup in new orders and output. Demand for manufacturing goods are improving. Business confidence is also moving up. One issue which remains a worry is the rising input costs, and the other concern is employment. The situation in Ukraine may also be a dampener in the coming few months. Lastly, number 1, India GDP. The GDP number for the third quarter showed that the economy had slowed down. While the number was expected to slow down, the numbers came in below the expectation. The surprise came from the manufacturing and industrial activities. It recorded very low growth numbers. Consumption and services, on the other hand, did quite well. The economy is struggling with supply constraints, high commodity prices, slowdown in the rural economy. What will happen to growth in the next quarter? India had faced the third wave of COVID 19 in the month of January. This had kept mobility low. This is likely to have an effect on the growth number. Also, towards the end of the February, the situation in Russia and Ukraine started taking shape. This is likely to keep the crude prices high. And if crude prices remain high for a sustainable period of time, it is going to affect both growth and inflation for the Indian economy. That is all for now. I am Moumita. Thank you for listening. If you are enjoying my podcast, please do like, comment, and share.